Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Nimesh Shah and Insull.
Welcome to The Tax Factor, our weekly podcast from Blick Rothenberg. Each week, our team of experts looks at the news and updates in the world of tax and provides analysis of what it might mean for you or your business. I'm Nimesh Shah, CEO of Blick Rothenberg, and we're here with you today, a day earlier, because of the Easter bank holiday weekend. So look out for some Easter eggs in this week's episode. I'll start us off with our very own Blick Rothenberg Easter egg, as joining me this week and making their Blick Rothenberg Tax Factor debut is corporate tax guru Neil Insull. Neil, welcome to the Tax Factor. I can't wait to get into some of your tax musings. But before I let you jump in, on last week's episode, Matt Crawford made a bet that we would be talking about non-doms and child benefit, two of my personal favourites. So I'm going to try really hard not to talk about either. And of course, any gambling winnings I take from Matt would of course be tax-free. So first off, Neil, I know you like to get stuck into some numbers. This week, we were treated to HMRC's monthly tax stats. And the government are doing pretty well, aren't they?
They're doing extraordinarily well, Nimesh. I mean, given what the economy is doing over the last 12 months, it makes really fascinating reading. So we've got 11 months worth of tax receipts taken to the end of February 24, and they're showing 761 billion. That's a 36 billion increase from the same period last year. And actually, that 761 billion is pretty close to what they collected in the whole of the 12 months in the previous year. So they're well on course to breaking all records in terms of receipts. And as I say, given that the economy is only just growing, if growing at all, it won't surprise you to know that as a percentage of GDP, we're at the highest percentage level, I think, from what I've been reading, since 1948. So there's some shattering records in terms of tax take, and does make quite interesting reading when you go down to the individual taxes. And I'm sure you'll have something to say about that as well, Nimesh.
You mentioned, Neil, there that the economy has been fairly flat. That's also been widely publicised in the media as well. So why are the government doing so well? And I think one of the reasons will be frozen allowance, which I'm sure you'll come on to in a moment. But are there any other taxes that are contributing to that record level of receipts?
I mean, we know all about those frozen thresholds, which have caused that fiscal drag and bringing more and more taxpayers into higher rates of tax. And when you look at the stats for the take on income tax, and particularly around PAYE, we're seeing very significant increases in the amount of tax take from that group of taxpayers, which is about the fiscal drag, the frozen thresholds, but also, of course, the earnings have increased in line with inflationary increases. So it's a bonanza time for the government now in terms of income tax and national insurance as well. The other thing that's caught my eye was, of course, corporation tax, an area of taxation that I deal with regularly. The tax take there has, again, increased quite significantly, another 10% compared to this period last year. So that's an £8 billion rise from last year. Not insignificant numbers, really quite extraordinary numbers given the economy and the position for a lot of corporates in the last year. I think some corporates, particularly in certain sectors, have benefited very well, the energy sector, of course, and there's been higher receipts there. But I think one of the things that we must factor in is that they increased the corporation tax rate in April 23 from 19% up to 25%. Now, that actually is a staggering 32% increase in the rate of corporation tax. Now, we haven't seen a 32% increase in the tax take. We've seen something somewhat less than that, which sort of indicates that maybe companies are not doing as well as those numbers might instantaneously suggest. But we are seeing some very important increases in taxes, tax rates, which are clearly benefiting the bottom line for the government.
I suppose on the corporation tax point as well, big changes around the full expensing regime, essentially capital deductions, 100% capital deductions for expenditure as well, which I'm sure has had an impact on that 32% increase on the rate that you mentioned as well. I've also been doing some poring over some stats, and actually this is following the spring budget as well. So what caught my eye, Neil, was that there was this 10 billion splurge from the government on the 2% national insurance cut. It was hailed by the government as offering the lowest effective personal tax rate in 50 years. That goes against actually what you've just been saying about taxes being at their highest level as a percentage of GDP since the 40s. But the continued freeze on personal allowances and thresholds is more than offsetting that. And the OBR, the Office of Budget Responsibility, put this in black and white, forecasting that the government is going to yield an extra 6.6 billion in the tax year 24-25, so the tax year starting in a few weeks' time, despite that 2% national insurance giveaway. So freezing income tax thresholds until 28-29, which is when this policy is due to run by, another 3 million people are going to be pulled into the higher and additional rates of income tax over that 5-year period. And that's going to result in net tax receipt increase of almost 20 billion. The net cuts were also announced in the autumn statement, which took effect in January. And those measures, in both in the autumn statement and the spring budget, reverse around half of the additional revenue that the government are raising from freezing thresholds. So over the next 5 tax years, frozen thresholds and allowances will yield 174 billion in total. But after deducting the net cuts, it's still a 72 billion net benefit to the government. So the government has delivered on tax cuts in its last 2 fiscal events at a cost of about 100 billion. But those frozen thresholds, allowances really continue to be a cash cow for this government. And you can see why a likely new Labour government is so reluctant to give that up as well. They've kept their powder dry so far on. Will they unlock those frozen allowances? And it'll be interesting to see if the new government will do anything around that as well.
Yeah, no, I agree entirely, Nimesh. I think what you say is absolutely right. I think the new Labour government, as it may well be, is on hiding to nothing in many ways. They really are being caught out by basically Keynesian economic policies being adopted by the Tory party over the last few years, basically doing what they want to do and raise taxes in the way that the Tories have. It's smoke and mirrors, and I think any changes that we've seen in the budget this year are really just political gestures, and we should just look at the long-term implications of some of those frozen thresholds, actually.
I'll be fascinated to see what comes out in those manifestos in a few months' time as well, to see how both parties are going to really deal with tax revenue raising measures, or if there's going to be some tax giveaways as well. Neil, you've been doing a bit more reflection as well on the fallout from the spring budget and the little known multiple dwellings relief. So I think with all the noise around NIC cuts, abolishing non-doms and reducing the top rate of CGT for resi property to 24%, this one got a little bit lost. So as a high level reminder, what is multiple dwellings relief? What was announced in the spring budget? And what do you think the impact of this is going to be?
It is an area which is considered to be a bit niche, but if you talk to anyone in the property arena, this is a big deal. What we've got is a relief called multiple dwellings relief, MDR as people will call it. It's been around since 2011, and it essentially a benefit for people buying more than one property at a time, and essentially tries to replicate the stamp duty that would be payable if you'd bought each of those dwellings, each of those residential properties separately. So effectively, the relief is giving the benefit of the lower rates of stamp duty on each of the individual property purchases that are being linked together in the bigger transaction. Now, this was originally brought in for the benefit primarily of the big property companies, the big institutional property owners, and was considered a very important relief for the housing market, for the rented housing market in particular. Then in 2016, it came to the attention of many advisors that a house with an annex might count as 2 dwellings in one. And there was an industry basically manufactured by a number of advisors, which went about claiming a very large number of reliefs for various property purchases with annexes attached like granny flats and so on, where they basically made huge savings in their stamp duty land tax charge on those property acquisitions. There was a consultation a couple of years ago where the government basically concluded that MDR was adding nothing to the property sector in terms of incentivizing property developers and was being abused big time. And they have decided, quite surprisingly, I think, amongst many people, not just to try to amend the relief, but as they say, throw the baby out of the bathwater altogether and actually abolish MDR. Now, MDR will disappear completely from the 1st of June 2024, so not so far away. If you've exchanged before budget day, you're okay as well. They're expecting, the revenue expecting to raise over 300 million every year for the next 5 years from the abolishment of this relief. Now, yes, what it does do, it stops the abuse, which I think everyone will applaud because it was pretty dodgy area of tax planning before. But this basically throws under the bus the entire property sector in terms of those credible large property owners, the institutional investors, those in the build-to-let sector, housing associations, and so forth, all of who have benefited, I would say, credibly from the relief and given them a reasonable level of stamp duty charge on those acquisitions. Now, that is no longer the case and will add to their burden of cost. There is what's called the rule of six, which is still a rule which applies where you buy 6 or more dwellings in a single transaction and you benefit from the lower commercial SDLT rates. Now that stays in effect, but really is only of benefit if each of the individual dwellings, I think this is what I learned from my good friend Sean Randall, who's a stamp duty guru, as everybody knows, basically only is of benefit where the average property price is more than $250,000. So this is something which will impact the property sector, the property rental sector. It is going to probably disincentivize a number of players in the market already, maybe redirect their efforts to other asset sectors. We will see. And I think, the lowering of the CGT charge, the capital gains charge from 28 to 24% also perhaps is another reason why we might see more exits from the letting market and actually put more pressure on the rented sector and putting more pressure on rents. So it's an area which is ambitious from the revenues point of view or the government's point of view, but I think to some extent there are some really difficult features in this which will impact the property sector for a number of years to come.
I was surprised when you said, Neil, that it only raises 300 million. I was expecting you to say a lot more. And at a time when the government has been talking about affordable housing, I don't know if that money is going to be channeled into that particular initiative from the government, but it's not going to scratch the surface, really. And as you say, the impact on house builders, the impact on housing associations, institutional investors, I think is going to be much vast here. And I think maybe, as you say, the government has thrown the baby out with the bathwater and not really thought about the wider impact on the abolishment of MDR. But I say I applaud the change there in terms of some of the abuse that we were seeing around MDR and some of those ambulance chasers that were trying to chase down savings when they didn't really exist in reality. I'm going to lose my bet to Matt now, Neil, because I can't resist this child benefit charge as well. And so very quickly, a big win for the taxpayer. They were allowed off a £250 penalty. And that was because the tribunal cited it was as a result of the ignorance of the law, though this person was actually a lawyer representing themselves at the tribunal. They contested child benefit charges of just over £2,000. There was a penalty associated with that as well of just over £250. The tribunal said, you need to cough up the child benefit charge, but we're going to let you off the penalty. That does not seem like a good use of tribunal time. But nevertheless, that's the ridiculousness of the child benefit system. I'm happy to lose my bet to Matt. And finally, we talked a little bit about what those manifestos might say. You spotted our first general election manifesto of sorts from the Reform Party and some pretty bold promises on tax there from the Reform Party. So what would the Reform Party do for their taxes in the very unlikely event that they come into government, Neil?
I should add that I've only added this in really because not so much it's a manifesto that's come to our attention, but the recent polling. So it was a YouGov poll where the Labour Party was well ahead, of course. But what was surprising to see is that Tories are on 19% and the Reform Party's on 15%. I mean, there's some very, very sharp increases in the support for the Reform Party, certainly at this point in the race. So it's worth mentioning what their tax. I'm not laughing. These are genuine tax policies from the Reform Party. And in fact, give them their due. Someone has thought hard about what this means, but it is a luxury manifesto in terms of policy. These are policies which, if you wanted to create a really fantastic tax system, you may well actually put in place. These are things which I think can be applauded in many ways. So they've got two plans. They've got an initial stimulus plan where they're saying, right, we're basically going to be truss again and do trussonomics and pursue growth within seconds of coming into power. So they're going to increase the personal allowance to 20,000. They're going to exempt profits for corporates up to 100,000. They're going to scrap VAT on energy bills, reduce VAT to 18%, lower fuel duty. This is all going to cost a mere 85 billion, and 50 billion of that is going to be from saving wasteful government spending. So what I'm expecting is schools to close, hospitals close, 1 in 10 of civil servants to be made redundant, and everybody work weekends. So that's their stimulus plan. And in the medium term, again, I'm not criticizing this plan, but this is unfunded in many ways. So they want to reduce corporation tax to 20%. So do I. I want them to reduce corporation tax anyway. They're going to increase the basic rate threshold to 70,000. Yes, that's quite a good idea. Is to reduce SDLT. Yes, please. Abolish the apprenticeship levy. Abolish business rates. Yeah, applaudable. Introduce an online delivery tax at 3%. So an Uber tax or whatever. And then increase the nil rate ban for inheritance taxes and simplify taxes. All very credible in terms of aspirational. But again, what is that going to cost? Well, they're saying they're going to scrap HS2 and save 100 billion in doing so, and that will pay for it every year, maybe? I don't know. 1 year? Well, I don't know how much it's going to cost every year. But I like it in the sense that this is the ideal. This is the world that we should be moving to in terms of, perhaps if we have that aspiration of reducing the position of the government in the UK, bring in all of this and see what happens. But I don't know. Do you want a heart operation next week? Maybe.
So there is some logic to the Reform Party's proposals in their sort of manifesto about how they're going to balance the books. I don't think that maybe they've quite thought about the recurring cost of those policy objectives, and just increasing the personal allowance year on year is going to cost you 8 billion, and they want to almost double it as well. So I think you're right. There's some definite big holes and unfunded amounts in those policy costings, albeit very light touch policy costings. Well, let's scrutinise over what the other political parties have to say when we get those little nuggets later on this year. I can't wait for that. My thanks to Neil for joining me on this week's Tax Factor. I need to go find £5 for Matt now, so he can treat himself to an Easter egg, probably a small one, given the effect of inflation and shrinkflation. So do enjoy your Easter, Matt. I'd like to remind you, there's lots of information and detail on the spring budget on the Blick Rothenberg website, with insights and analysis from our team of experts, and features our world-famous tax calculator. So you can see whether you are better or worse off. At last count, over 26 million of you have used the tax calculator. Check whether your finances are better or worse off in the forthcoming tax year. You can also download our free Tax Facts guide, which has been fully updated following the budget with the latest tax rates and allowances for the 24-25 tax year. What better way to spend your Easter weekend? Visit the Blick Rothenberg website and follow the links on the homepage.
Oh, and I should add that you can also find the next episode of our Success Story series on the website. Each episode focuses on one of our clients' journeys to success and their advice to other businesses and entrepreneurs. In this one, my good colleague Dan Burke from the audit department here talks to Dino Sura. He's the managing director of the global restaurant business Burger and Lobster. I have watched it, and it really is worth a couple of minutes of your viewing time too.
I'm back again next week with Tax Factor regular Heather Self. I'm Nimesh Shah. Thank you for listening. Enjoy your holiday weekend, whatever you're doing, and goodbye.
Goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on the Tax Factor.